Coming up today, the Nasdaq hits a new record. Are stocks headed for a melt-up? Gemini hits the market. Why is Tesla up over 7% today? Is it time to sell gold? What to look out for next week? And the little-known stock I think could be the next retail favorite like Open Door Technologies. It's been a huge week, guys. Let's go. And welcome back, everybody, to Click Capital. I'm your host, Jared, and I'm going to get you all up to speed on everything important happening in financial markets today, which was mostly a bearish day, especially looking at this heat map of large cap stocks, except for a few mega cap techs. And I'll tell you later on why Tesla's up so much today, but it's really underneath the surface where there's plenty going on, especially in small caps. So stick with me today, because later on in this video, I'm going to share with you some research on what I think could potentially be the next retail favorite stock like Open Door Technologies, which has ripped up massively of late. And this stock I'm going to profile today is largely undiscovered at this point in time, but it has a lot of positive developments and potential going forward. It's actually an old popular brand you'll remember right away, so stay tuned in for that because I'm going to do a deep dive on it. I'll show you their website and explain to you why I think it could be the next hot stock, as this is one I haven't covered here on the daily market review before. So I think you'll really enjoy that. And also today I'll give you an update on how my stock picks and options trading services have performing. I'll share with you the stats on them. And so it's the weekend, guys. Sit back, relax, and enjoy the show. It's going to be a good one. But first off, just a little bit about the market. There's still a lot of fear, uncertainty, and doubt, FUD, on this stock market rally. Even though we've got the main S&P and Nasdaq indices sitting at all-time highs, we've still got the fear and greed index in the neutral zone. Showing plenty in this market are not all that enthusiastic about this rally, and that showed up really once again in the investor sentiment survey, tilting more bearish than what we've seen in a few months. And I think a big part of that was such a consensus coming into this month that we're going to see a pullback after we've had this amazing V-shaped recovery and rally with the market just grinding higher, and September historically being the weakest month of the year. I think that's caused a lot of investors to dial back their expectations, and that's what's also caused a bit of bearish sentiment here. That's still really lingering around from the events earlier this year, which caused the S&P to actually fall 20% from its highs and more than 15% from where we started the year. And looking back in history, that typically doesn't bode well for the rest of the year. It can often mean a negative yearly return. However, when the market does bounce back, it can often bring a double-digit yearly return, which represents big gains, especially off the lows. And so far in September, the S&P's up almost 2%, and we appear to be grinding higher into the important Fed meeting this coming Wednesday, which I'll also touch on later with my thoughts on what could happen there, as this bull market is almost 3 years old. And looking back in history, when bull markets make it past their second birthday, they typically can go on for some time. And if the AI boom's anything like the internet boom, which didn't top out until March 2000, it could suggest there's quite a few more years left in this bull market. And again, we came into the year with a wide consensus that it was going to be a soft year, like we'd normally see in the third year of a bull market. However, we're only 2 weeks away from Q4, then we'll be into year 4 of this bull market, and that's typically when returns pick up again, and it's normally the first year that bounce off the lows. That's always the best year of the bull market. But no doubt, so many investors have issue with valuation. No doubt they are high on historical measures, with the S&P 500 trading at 22.7 times forward earnings. No doubt a premium over history, still a little bit off what we saw in the late 90s, got up to about 26 there. And so there's really two big drivers of stocks and the stock market as a whole, and that is earnings growth. If a company or the market is growing earnings, prices must go up just to retain the same multiple. But also, if investors get more enthusiastic about owning stocks, that can cause an expansion in multiples. But what really unlocks big gains is when you get both at the same time, growth in earnings and the expansion of price earnings multiples. And that's basically what the market is in today, with overall double-digit earnings growth and climbing multiples. And so another big criticism of this AI bull market led by NVIDIA is that it's just like Cisco back in the late 90s. Therefore, the exact same thing is about to happen. But there's a big key difference between Cisco in the late 90s, which was kind of like the picks and shovels provider of the internet boom, the same as NVIDIA is for the AI boom, is that there was a huge divergence between Cisco's stock price and their earning. Whereas with NVIDIA, the stock price has pretty much been growing in lockstep with earnings, which has been increasing just as much as the stock price. And I mean, NVIDIA still trades on a price earnings growth ratio peg a little above 1, meaning its PE multiple is just a little bit above its expected earnings growth rate next year, and that could very well be exceeded. And so in my opinion, NVIDIA's valuation today is not as far stretched relative to its earnings as Cisco was back in early 2000. 2000. And another thing we saw in the late 90s, and in addition in 07, 08, going into the global financial crisis, was as usual, the bond market can see it coming. Looking at investment grade technology credit spreads, the premium that bond investors demand over treasuries to lend their money to tech companies. And so tech credit spreads were climbing back in the late 90s and again in 07 and 08. Here we are today at rock bottom low. And of course, that means we're on our way to the top. Very well could be closer to the top than the bottom, but it can grind down there for some time. It's only when it starts curling up and breaking out that we really need to pay attention. And in addition to tight credit spreads, we're also about to resume the Fed rate cutting cycle. Interest rates are about to come down. And that can be a great thing for the stock market. It's actually similar to what happened back in 1998. The Fed started cutting rates, and it really helped to fuel that last melt up in the internet boom. Before valuations got so ridiculous, along with the Fed pausing, helped to form a top. But another interesting thing we've got going on, as Jim Paulson pointed out, an investment professional, is that the Fed ease will be big for the stock market. This is the only bull market in post-war history which has lived its entire existence with negative excess financial liquidity and with an inverted yield curve. This is about to change and stocks will love it. And we can see that in the 10-year treasury yield, less Fed funds rate. The last couple of years has been negative, and especially so looking at the annual M2 money supply growth, less GDP growth. And that's been a big difference from the 2010s, the mid-2000s, and even the mid-late 90s. In other words, money growth was higher than GDP growth. And so we've kind of got a unique setup here that is really different from what we've seen in the past. Because the labor market is definitely weakening, pretty much mandating the Fed to lower rates. But is that actually doing the AI boom and the whole stock market a favor, which could actually see us go into a melt up? Because going forward, the stock market may not rely on labor market growth as much as before, changing the rules of economics forever. Also, the events from 2020 may have altered things in ways we are still yet to fully understand for many more years to come in terms of liquidity, inflation, working from home, etc. And I mean, the yield curve indicator, which has long been considered the gold standard in finance, did just get it wrong. And so maybe the signal the jobs market is sending us could be wrong as well. And if we are to liken this to the late 90s internet boom, maybe we are in a similar spot to late 99, or even I would say after 88, they had a big V-shaped recovery, then the Fed cut rate. Maybe around somewhere like here. And even back then, a lot of people thought the market was ridiculously overpriced. They were shorting it, caused a lot of traders and hedge funds to blow up. Even Stanley Druckenmiller lost billions of dollars shorting tech stock, calls it one of his biggest mistakes because the index went on to more than double over the next year and a half. But right now, we don't have this crazy melt up price action yet. So that's definitely possible. And I think a lot of investors are ignoring the upside risks, as many of them are so fixated on downside risks. And so what you'll see in raging bull market is a rush of private companies going public, selling their shares to institutions and the public to raise capital, to use for expansion, exit liquidity, and just gain more exposure. And we just got the latest today. Gemini Space Station, the crypto brokerage firm run by the Winklevoss twins, and yet another successful crypto IPO. There's been a whole string of them lately, helping the twins to get $3 billion richer today, and no doubt making the rest of their team rich as well. They're all looking pretty happy there today. And in addition to running a crypto exchange, they've also got an active trading platform for trading crypto, even run their own stablecoin, the Gemini dollar. They offer staking on crypto so you can earn a yield, and they have a Gemini credit card that allows you to earn up to 4% crypto back on every purchase with no annual fee, which is definitely an appealing product for those in favor of crypto. And of course, they have institutional crypto services as well, allowing big businesses to trade and custodian their crypto asset. It was a successful IPO, being priced at $28 a share. I would have expected it to finish a bit higher today. Only finished at a $4 premium over the IPO price, and this will definitely be a retail trader favorite going forward. Stock ticker Gemmy, and could very well have the potential for a run-up like we've seen in some other crypto-related IPOs of late. Circle Internet Group, the company behind USD Coin, had a monster rip from $70 a share all the way up to almost $300 in just a couple of weeks before pulling back. But we have seen some others being a little soft, like bullish, and we did just get one yesterday, blockchain lender Figure, and that actually finished at a higher premium. It was priced at 25 yesterday. But stick with me because later on I'll show you what hot crypto stocks are actually ripping hard today. Some of these small caps really starting to go on a run as Bitcoin potentially looks to be making its way back to all-time highs here. But more on that later. And again, this increase in IPOs coming to market is causing many to sound the alarms that the dot-com bubble is back, which they saw a lot of internet IPOs back then as well. Any stock that had .com in its name had a huge rip. But what else is ripping today? One of my favorites, Tesla, up over 7% on no big headlines. See a lot of people wondering, why is it it up so much today? Well, there's a few things. As we've been noting, of late, the last couple of months, the stock price has been coiling up in a tight consolidation. And like I've been saying over the past week, I had a feeling it was going to break out on the upside as investors move their focus away from declining EV sales to what's around the corner next. And so Tesla isn't just about electric vehicles anymore. Investors are pricing in its energy storage growth with news earlier this week on their new mega block infrastructure and continued regulatory wins for self-driving testing, and with EV tax credits set to expire soon. That may have caused a little bump up in sales. So Q3 could very well beat on expectations. And also you could think of Tesla as a long duration asset that is sensitive to interest rates. And so the market's pricing in lower rates. Since Tesla offers big ticket items, the cost of financing them is going to come down. So that's definitely a tailwind for the stock. And in addition to robo-taxis, Elon's been talking up recently the latest optimist bot V3, which is still yet to be publicly revealed. No release date on it soon, but I was listening to him on a podcast recently, and he just said they've made major advancements in the dexterity of hands, which he says is the most important and hardest thing to get right on humanoids. And he believes Optimus V3 is head and shoulders above the industry. And he believes V3 is kind of the breakthrough that makes these things pretty much near human and what they can actually do, along with the latest AI chips, allowing them to read the real world. And he's hoping once they get to scale, 1 million plus units produced per year, Tesla should be able to do it for a cost of $25,000 or thereabouts, which means they could retail them for about $35-40, which no doubt isn't for everybody, but I would say even the top 10 or 20% of income earning consumers is definitely a possibility for them. And so me personally, I think the Optimus bot is going to be the biggest product and game changer of our lifetime. And that's why Tesla deserves a huge premium when just looking back at their past 12 months cash flow, because what's in front of them is way greater than what's behind them. And I think the market also appreciates Elon stepping back from politics, which as an investor, I do as well. Even though I think his heart was in the right place, whenever you get into politics, you inevitably upset half the population. And so now he's back to war mode, sleeping on the factory floor, working around the clock, doing everything he can to make his companies succeed. And so I think the market really likes that. And after his friend Larry Ellison snatched the top spot of the world's richest man earlier this week, thanks to Oracle's huge rally after earnings and forward guidance, after the rip in Tesla shares today, Elon's back up on top, on his way to being worth $500 billion. And he's actually got more net worth in his private companies now than he does in Tesla, as he owns about 42% of SpaceX, most recently valued at $400 billion. And more importantly, he has almost 80% of the voting shares. So he's got near total control over the direction of SpaceX, and that's what he wants for Tesla as well. And it's more the control than the actual wealth that's important when it comes to his share ownership, something the mainstream media just can't wrap their heads around. Speaking of which, big shout out to Tim Waltz for absolutely nailing the low. Earlier this year, when he gave a presentation saying the Tesla stock's 220 and falling, it's now up 73% since then. And like I said back on that day, it was likely to give us an iconic Tim Waltz bottom we can talk about for years to come. Now just moving on from large caps and tech, just looking at valuations of countries. No doubt the States at the top end of its range. On the other side is emerging markets, which is actually below its historical range, just over 9 times forward earnings. And actually my retirement fund recently swapped an Australian financial stock ETF for the emerging market stock ETF as I run a momentum strategy in my retirement fund. Click the link below this video if you want to learn more about it. I've got a free ebook there, and that's been performing really well this year, and especially so this week thanks to emerging markets as a whole breaking out, looking really good on the chart. What's also been doing well this week is my stock picks portfolio, which is largely focused on small caps. And just like the late 90s, we've got this huge divergence between the valuations in large caps and small caps. It's like a big alligator's jaw, which will at some point snap and close. And so even if we are on the verge of AI mega cap tech stocks underperforming, just like from the late 90s all the way through to 2011, small caps outperformed the large cap. It was over a decade of outperformance from small caps. And we can see that here in the spread chart of the Russell 2000 versus the S&P 500. And that's why I continue to hold some exposure to small caps going forward. But most of the market does not. We can see that in the ETF market share of small caps. Looking at the assets under management in small cap ETFs as a percentage of all domestic equity ETFs, that's at all-time lows. It's only 6%. Think about that. Only 6% of all domestic equity assets under management are in small caps. And this is something we saw in commodities a few years ago. Gold, silver, uranium, which is still normalizing, a massive underallocation from the investment community. But we've recently seen an outperformance of small caps versus large caps this last month off this really long base after a long period of underperformance here. And underneath the surface, we're seeing some big moves in small cap growth. And just to share with you guys, a few stocks I have in my stock picks portfolio doing well this week. Microvast Holdings, as battery storage stocks have been lighting up. Idaho Strategic Resources, who have the largest rare earth deposits in the States, breaking out to brand new all-time highs today. Life 360 having a good week. Location sharing services. Earth Imaging Company Planet Labs having a monster week after its 48% rip on Monday after good earnings. And of course, the AI infrastructure trade gathering momentum this week with InnoData and a huge retail favorite now, Iron Limited. It too having a monster week. Helping my stock picks portfolio have a great week. And I thought I'd give you guys an update on its performance. And so for those of you who don't know, I started the stock picks portfolio back in June last year as a way to demonstrate the power of consistent saving and investing. Every Sunday I send out my latest weekly stock pick with a deep dive research report, and then I buy that stock the next day. I started with $500 a week, increasing that 10% a year. So the last couple of months, every Monday I buy $550 of a new stock. And so I know the portfolio and gain are not huge numbers. It's actually the smallest of my 7 portfolios that I manage for myself. But this is still early days. The goal is to turn this portfolio into $1 million US plus in less than 10 years. And I'm on track to do that since I buy a new stock every week. With new funds being added to the account, we look at a time-weighted return, and my stock picks portfolio is up over 34% since starting it. And just looking at my benchmark, the Vanguard Small Cap Index Fund, which is pretty much exactly like the Russell 2000 Small Cap Index, that's up 19% in the same period. In other words, my stock picks portfolio has delivered an 80% better gain than the benchmark Small Cap Index. And with a lower drawdown as well. The Russell 2000 had a 30% drawdown going into the tariff tantrum in early April. Quite a sizable move in the broad market, almost lost a third. Not something we see too often, and of course, like all portfolios and strategies, we had a drawdown then as well, but my stock picks portfolio only had a 22% drawdown, and I actually made a few changes after that to reduce volatility in my portfolio, and you can see that with the equity curve after that period of time, and I've actually got my beta down to 0.85, and so the beta of the market is 1, meaning my portfolio is about 15% less volatile than the market, and I'm most proud of my Sharpe ratio at 1.12. For those of you who don't know, Sharpe ratio is a measure of return for every unit of risk, kind of like volatility adjusted returns. Long term, the market has an average Sharpe ratio around 0.35, and that's because we can see those big 40-50% drawdowns when the market only averages 8, 9, 10% a year. And so in other words, my stock picks portfolio has been delivering higher returns with less volatility and risk, and again, I believe this is just the start. I think that outperformance is going to accelerate going forward, not only against the small cap benchmark, but potentially against the market as a whole. So like I said, small caps have a lot more potential going forward, in my opinion. And there's a look at the portfolio's equity curve. You can see the power of dollar cost averaging, buying a new stock every Monday, along with sticking to a good strategy, cutting your losers, holding your winners, following the trends, staying well diversified. That helps create a smooth uptrending equity curve and makes it a lot easier to stay invested for the long run. And just to give you guys a quick update on my options trading service results. Every day in the last hour of US market trading, I share my options trades in real time with screenshots straight from my trading account as soon as I've made the trades. In the members only private chat room. And I launched this service back in May this year. And looking at my closed trade stats, it's been 156 trades. 56% of them have resulted in a profit with a net profit of over $10,500 US. And that's never using more than $50,000 in total margin either. And so if you want to get access to my stock picks and or my options chat room, then I suggest you wait until the 25th of September, because in addition to launching my new ETF portfolio service, I'll also be extending a big discount for launch week only on package deals. So you can combine my premium services for the biggest saving. And if you'd like to learn more about my ETF investing strategy, click the link below this video and head on over to my website, clickcapital.io, and read my free ebook over the weekend. I'll show you proof of my returns from running this strategy the last 3 years in my retirement account. And I'm about to run it in a brand new account with $100,000 of my own money on US listed ETFs. And so then I'll have a service for stocks, options, and ETF. And those are the 3 asset classes where I invest my money. And so I offer them as a way to demonstrate what successful trading and investing everything looks like in real time. And so make sure you stay locked in here with Click Capital, because in less than 2 weeks, ETF portfolio will be going live. And like I said, I'll be offering a big discount for that launch week only for the new service and package deals. So you can get access to my stock picks and options trading chat room as well. Now just moving on to what I alluded to at the start of this video. What stock I think could potentially be the next retail favorite after the huge success we've seen in open door technologies lately. And yes, retail traders can identify the next big winner. Guy I follow on X, who goes by the name Heisenberg after the great show Breaking Bad. He posted back on the 17th of July, open 23% short interest. Is this the next FinTwit retail name to pump? As it was already popular on financial Twitter back then. The Reddit apes are saying it's the next Carvana, referring to all the traders over on Reddit. Wall Street bets, worth a speculative YOLO, you only live once. And here's a look at open, which has had a massive week. Bit of a pullback today, but that's completely normal. And uptrends just allows the stock to consolidate. But Heisenberg gave it out back on the 17th of July, back when it was trading at $1.65 a share, which has gone up more than 5x in that time, just a couple of months. Went up almost 80% just yesterday on massive trading volume. And remember, us retail traders now, as a group, represent more trading volume than hedge funds. And I think it's going to continue to grow. So what could be the next one? Well, let me make a case to you that it could potentially be BlackBerry, ticker symbol BB. And before I show you the chart and why I think it has a lot of potential, first, just a little history on BlackBerry. Originally started off in 1984 as research in motion by a bunch of guys coming out of Ontario, Canada. But it wasn't until the late 90s, going into the 2000s, they became really popular with their BlackBerry phones. It was kind of like the golden standard in business. Every executive, lawyer, politician pretty much had one. Physical keyboard, push email, and strong encryption made it the standard for mobile productivity. However, something happened in 2007 that would change BlackBerry forever. A guy by the name of Steve Jobs released the iPhone, which mainstream media and skeptics highly doubted, and he even said back then his goal was to try and get to 1% market share, as he was still turning around Apple after it significantly underperformed. He was actually kicked out by the board in the 80s, came back, created the iPod, and then went on to create the iPhone, which, as we all know, transformed Apple and made it the huge winning stock that it is today. But also, that's what caused a peak in BlackBerry and its downfall, huge loss of market share as the iPhone replaced the BlackBerry. And the stock's largely been in the doldrums since then. And here we are today, trading at $3.90 a share with a market cap of $2.32 billion. So BlackBerry eventually realized all that. And in 2016, they pivoted away from being a hardware maker and stopped designing and producing smartphones themselves and instead focused on software. Today, BlackBerry is now a cybersecurity, Internet of Things, and automotive systems software provider. Phone era is history, but the brand lives on as a software and security company. Now, first, I must give a shout out to one of my regular viewers who has the online handle Rippin' and Trading for first bringing this to my attention, mentioning the QNX platform to me about a month or so ago. I've had some time to look into it myself since then, and I like what I see. And so it's been a long turnaround that's still taking place, that has guided revenue higher, returning to profitability for the first time in years, and its QNX platform is actually embedded in millions of vehicles worldwide, giving it long-term exposure to the automotive software boom. In fact, NVIDIA's Drive OS runs on top of QNX. In addition, NVIDIA launched Jetson Thor, physical AI edge compute, which runs on Drive OS, and this is in addition to their secure communications and cybersecurity software. But it's really their QNX platform that's the most exciting thing. It's actually installed in over 250 million cars around the world. Helps to run infotainment systems, digital dashboards, and safety features, kind of like the invisible software powering modern vehicles. And I believe there's good reason to expect QNX to become the leading revenue and profit driver for BlackBerry over the next few years, especially if the company continues executing, winning contracts, and expanding into adjacent spaces like industrial robotics and potentially other industries as well, drones, surgical robots, warehouse automation systems, as more devices and robots actually run AI at the edge. And so that's locally, not in the cloud. And that's because they need to make split-second decisions. They can't have any lag having to signal back to the cloud. And this is especially important for safety critical functions right on the device. And so it means like a self-driving car doesn't have to wait for a GPS signal or a cloud server to tell it when to brake. The decision is made instantly on a trusted real-time operating system like BlackBerry's QNX. Cloud will still play a role in like maps, updates, big data, but the actual intelligence that helps keep people safe and machines reliable will increasingly be run locally on the device. And with their partnerships with NVIDIA and others like Qualcomm, I think that shift towards software-defined vehicles will mirror in robotics, and BlackBerry could position itself as a standard operating system and security stack for robots in the same way as it has done for cars. And so even though the stock price is up a little bit from year to date, just going out to the monthly chart, it is still pretty much beaten down, trading in the low single digits here. And the revenue has been falling the last couple of years because legacy parts of the business have shrunk. Their cybersecurity unit has cooled, and they've had a few underperforming units dragging them down. And so the turnaround really hinges on whether QNX can grow fast. It's already over 40% of their revenue. And so while they don't build robots or AI models, I think they have a niche to become the trusted operating system and security shield for AI-powered machines across multiple industries. And so that's about keeping data safe, machines smarter, and communications locked down. And that's why I think it's a compelling, under-the-radar growth story. Management's buying back shares, and if they execute right, it could be a classic comeback stock that rewards patient investors. And so definitely one to keep an eye on. And just as a friendly reminder, all my content and premium Click Capital services are not financial advice. Please do your own research. I'm just sharing my research and opinion with you in the hopes you enjoy my content and learn something new. Now just moving on to the macro. We're still getting plenty of calls that we're on the cusp of stagflation, declining economic growth with increasing inflation. Some even saying we're already in stagflation light. Many financial advisors and wealth management companies advising clients to raise cash and de-risk their portfolios, and of course, increase exposure to gold. I've seen a number of Wall Street banks saying that of late, including UBS, which came out yesterday and said there's 93% chance we're going to see a recession. And I think all that rhetoric is adding to the rally in the precious metal, really been ripping these last few weeks. No doubt the prospect of lower rates is adding to that. But is it time to sell? And just looking at the most popular gold ETF, GLD, over 114 billion assets under management, currently sitting at all-time highs, and just going out to a monthly chart on this, that is absolutely walking the line, melting up here. Now, whether to sell some or not depends on the investor, as usual, and their objectives and so on. I think it's not bad to always own a little gold. It is a great portfolio diversifier, but it is a non-productive, non-yielding asset. And so there isn't anything wrong taking a few chips off the table into strength here, but it is in a strong parabolic move. And the easiest way to ride that up is just by using moving averages with a 200-day MA here. And so as long as it's above the 200-day MA, it's still uptrending. And so you could use that as a line in the sand or a support zone, or even just a 10-15% trailing stop from the most recent high. And that's the best way to follow trend. Otherwise, there's no telling how high it can go. And I actually think there's more potential in silver, which has still got a lot of catching up to do with gold, just looking at the monthly chart of silver versus gold. So if I was selling a little bit of gold, I would rotate the proceeds into silver and still keep the same exposure to precious metals. But it could also be the prospect of lower rates, and many investors still convinced we're still going to see a huge amount of tariff-induced inflation that's helping to keep gold bid here. But just looking at the latest inflation data, CPI, we got on Wednesday, it was really showing up in shelter, which is not really affected by tariffs. In fact, categories that should be impacted by tariffs the most, like furniture and recreational goods, did see some price spikes in June, but those have since faded. And Robin Brooks may be right. It could be the tariff inflation shock may already be over, as once again, economists are still telling us it's going to be next month or next quarter. We're going to finally see the inflation effects from tariffs. We've barely had a little bump up in the normal ebb and flow thing, but some are still convinced we're going to see a tidal wave of inflation. And again, that's probably what's creating a bit of skepticism on the stock market rally and that rotation into gold. But those just initiating a position now in gold, well, there's a look at the 3-month chart on gold futures, which my reversal signals indicator has been firing off. The last couple of times that happened, gold did underperform quite a few years there. So I definitely wouldn't be initiating new positions up here. Looks a little Johnny come lately to me, but like I said, nothing wrong with taking a few chips off the table, maybe rotating into silver. Otherwise, just keep riding it using moving averages. Very well could hit 4,000, even 5,000 if things go parabolic. Nobody knows for sure. And at the end of the day, actual inflation in the economy is still tracking around 2%. And companies talking about tariffs on their earnings calls has actually subsided a lot in the most recent quarter. Obviously a huge focus in Q1 this year. So have we seen the worst of it with tariffs? Well, I guess we'll really find out come the end of Q4, because if we haven't seen a big wave of inflation by the new year, I don't think we will. But no doubt that's got plenty of consumers worried, not only inflation, but the weakness in the jobs market, which could already be contracting. Saw a massive revision on Tuesday. Almost 1 million less jobs than what was previously reported over the last year. And no surprise today to see consumer sentiment once again hit a multi-month low. And we are seeing a rise in credit card delinquencies. Consumers unable to pay their bills, which for sure, just like the jobs market, is something we normally see going into a recession. There's no doubt about that. And that is convincing many people that Wall Street is so out of step with the economy, because every other time we've seen job openings fall and unemployment rise, it eventually caused a recession and a bear market in stocks. And this is going to be the big theme going into Q4. Will this divergence close? And who knows, maybe we see a turnaround in the jobs market. I think that would catch everyone by surprise because no one's talking about that. Or is the stock market finally going to pull back in line with the economy? Or are we going into something new thanks to AI and robotic? The big event for next week will be the Fed meeting on Wednesday, widely expected to resume their rate cutting cycle for the first time this year. Market giving them a 95% chance we'll see a quarter point cut. Still a little chance we could get a big cut and we could see dissent again among Fed members, just like last meeting. They weren't all on the same page, and those that dissented actually turned out to be right because they probably should have cut in July. So if they did do a big cut, could be a bit of catch up. Maybe they just want to race out in front of this quickly weakening jobs market. Like I've been saying for a few months, the Fed needs to move to help all those struggling consumers. Instead, J Powell's been telling us all year inflation's coming because of tariffs. But that argument appears to be quickly fading. And we are well and truly in a global easing cycle. The last move from pretty much every central bank being to cut their interest rate. And overall, looking around the world, most places inflation is still where it should be, between 1% and 3%. And so global financial conditions are easing, liquidity's rising, and we've got plenty of momentum around the world. And we'll also get to look at retail sales on Tuesday. A few other bits and pieces, but it'll really be the Fed in focus, and weekly jobless claims on Thursday after we saw that spike yesterday as well, out to a new 3-year high. And that could very well prompt the Fed to strongly consider restarting with a big cut. And just getting back to the charts and what's moving out there today, the crypto miners having a great week. Cypher mining up over 8% and real strong rips in some other crypto stocks, Bitfarms and Hype Digital Technologies. Big volume coming into these names, just like iron, along with a nice bump up in Ethereum to finish the week. Not too far off all-time highs either. Could very well test a big psychological 5,000 next week. I'll also be paying attention to the Russell 2000 Small Cap Index, as it too sits just below all-time highs. How will the market react on Wednesday after we get the Fed rate cut? Will it sell off if we get a 25 basis point cut? Buy the rumor, sell the news? Or could we possibly get a big cut, lighting the market up even more? But once again, the options market is not forecasting fireworks. The VIX 9-day measuring expected volatility over the next 9 trading days, very low here, 12.85. In other words, the options market's only expecting the S&P to move up and down by 0.75 of a percentage point each day over the next 9 days. And so if the options market is right, which it usually is, we shouldn't see a huge move coming out of the Fed meeting. And instead, we could be on the cusp of melting up. Mag 7 been doing really well, especially Alphabet Google sitting at all-time highs. And it's normally when we go into that hard melt up, that's when volatility begins to rise as the option market begins to price in the correction. So we're still yet to see that. So next week will be interesting for sure. Make sure you subscribe to this channel, click capital if you haven't already, and keep hitting that like button, and these videos will continue to show up in your feed as I make a new video every day a few hours after market close. Otherwise, have a great weekend. Thanks for tuning in. And if you're interested in learning more about my ETF investing strategy, then click the link below this video and read my free ebook before I pull it down next week. Thanks a lot, guys, and I'll see you back here again come Monday night. Cheers.